The economy is tanking, so why aren't home prices dropping? We'll talk about a couple of the numbers that I think are going to influence what ends up happening and how you might be able to time things. This is one of those rare situations where we may have our hands on more of a realistic crystal ball than typical. Hey everybody, welcome back to the VIP Financial Ed YouTube channel. This video is the real estate market is doomed 2.0. Had some decent traction on my real estate is doomed opinions from a little more than a month ago.
When you have a 30% unemployment rate, and the second that people start to foreclose and short sale, the property values in your neighborhood, the property values in my neighborhoods are going to plummet.
And I want to revisit that conversation because obviously we've been provided with a lot more data since then as the coronavirus has progressed. And I want to talk a little bit about what it means to you, perhaps even how to time the market, as well as solutions that you can take advantage of regardless of what ends up happening, whether my opinions end up being right or completely wrong. But I want to start this video off by reviewing in detail an article that was recently written as of May 21st by Jeff Andrews called "The Economy is Tanking, so why aren't home prices dropping?" I think some interesting information will come from this, and then we'll bring on my special guests. So be sure to stay to the end. Drop a like on this video if you want us to continue talking about real estate and what is in store, and make sure you're a subscriber as well. All right, so the article goes on to say more than 38 million Americans have lost their jobs since the outbreak of COVID. Stay-at-home orders have grounded much of the economy, prompting trillions in stimulus spending by the government in hopes of keeping industries afloat. But anyone hoping a silver lining to the economic chaos would be deals in the housing market have thus far been disappointed. For the week ending May 9th, the median listing price in the United States was up 1.4% year over year, according to Realtor.com. Existing home sales in April fell by almost 18%, but prices rose by 7.4% compared to a year ago. So why isn't the tanking economy bringing home prices down with it? Jeff goes on to break it down. The price of anything is a function of the relationship between supply and demand. Generally, home prices have been pushed up over the last 5 years by high demand, creating a then booming economy and a low supply of housing for sale, due in part to relatively low levels of housing construction and available land on which to build. After the outbreak of the pandemic, housing demand fell as buyers lost their jobs, part of their income, or simply didn't want to shop for a home in the middle of a viral outbreak and what figures to be a period of great economic uncertainty. Demand dropping was evident in a number of metrics. Although a weak indicator of buyer demand, traffic to real estate portals like Zillow and Redfin dropped significantly in the beginning of the outbreak, as did more reliable indicators like pending home sales and weekly mortgage applications. Usually, a drop in demand would put downward pressure on prices. Home sellers would be competing with each other to attract a limited number of buyers by dropping their asking price. But while housing demand has dropped substantially, housing supply has also dropped in lockstep as potential home sellers pulled out of the market for many of the same reasons that buyers are. New home listings is a good indicator of housing supply, and after stay-at-home orders were enacted, new home listings cratered by as much as 80% year over year. Redfin supported that 41% of offers were subject to a bidding war over the last month, suggesting demand has outpaced supply, just as it was before the pandemic. While both supply and demand have dropped, the relationship between the two went largely unchanged, meaning that the drop in supply and demand were generally proportional to each other. Jeff says, furthermore, home sales also dropped after the pandemic hit, and it's hard for prices to move when there aren't as many housing transactions to make prices move in aggregate. Together, this leaves prices much where they were before the pandemic hit, basically flatlining. This is consistent with how housing markets have fared in previous pandemics. A Zillow study looked at housing markets in cities hit by previous pandemics in Asia and found that whole activities dropped, home prices didn't move much. A good way to think about the housing market at this moment is that it's on pause. Buyers and sellers have left the market, transactions have dropped in response, and prices just aren't moving. For a comparison point, the relationship between supply and demand was very different before and during the 2008 financial crisis. Prior to the collapse, shady lending practices created excess demand for housing by bridging unqualified buyers to the market. And then home builders were responding by increasing construction to meet the demand. And when the financial system locked up, it brought the excess housing demand to a halt because banks weren't able to lend in the same volume. Not to mention the recession then collapsed the economy, and then it caused unemployment to rise and then buyers to drop out of the marketplace. Now, at the same time, banks foreclosed on houses in the millions, which gave housing supply that was already high from these home builders constructing in excess. And this suddenly piled up these foreclosed homes on top of it. It created this nightmare scenario for the market. Low demand, very high supply, home prices obviously plummeted. This scenario is highly unlikely, according to Jeff, to play out again for two main reasons, which I find very interesting. The first is that there was already a housing supply shortage prior to the pandemic, so any addition to the housing supply wouldn't be exacerbated and causing, the already existing oversupply problem like in 2008. Second, a foreclosure crisis on the scale of 2008 is unlikely, at least in the near term, because the federal government has placed these moratoriums on foreclosures and on federally backed mortgages and have directed the mortgage industry to offer mortgage forbearances for up to a year to homeowners who have been impacted financially by the pandemic. Now, assuming this stays in place, a wave of foreclosures won't lead to a supply spike that puts downward pressure on home prices. But given the situation is fluid, it certainly can't be ruled out. He admits to that. And the federal moratorium, when that's lifted, will certainly contribute. While 2008 obviously destroyed the housing market, previous recessions have barely moved at all. If anything, prices went up. Found a great website that you guys can check out called littlebighomes.com. That would contribute to your research on this subject. We'll throw a graph up here as well. Now, the current conditions haven't led to a short-term price drop. The long-term economic trends induced will likely affect prices in the future. Zillow economist Skylar Olson says that Zillow is forecasting a price drop of 2 to 3% through the end of 2020, depending on the city, compared to where prices were in February. We don't expect prices to fall by much, at least nothing like the last crisis, because housing in general is much more resilient than it was the last time, she says. We didn't have excess building driven by excess credit that drove excess homeowners. We don't have excess in housing. There are faint signals that the housing markets are slowly building back up. Demand metrics like mortgage applications are up and pending home sales have returned close to their normal in cities less impacted by the pandemic. However, pending home sales in cities hit hardest on the coast remain down significantly year over year, and markets across the country remain supply constrained as new home listings remain down year over year, even in cities that haven't been hit as hard by the pandemic. So I want to have an opportunity to respond to some of that. We'll talk about a couple of the numbers that I think are going to influence what ends up happening and how you might be able to time things briefly. This is one of those rare situations where we may have our hands on more of a realistic crystal ball than typical. And I want to have this conversation with our good friend and channel friend, sponsor here of the channel, Mr. Michael Mathe, who is a longtime real estate investor himself. So welcome back to the channel, Michael. Thanks.
Thank you. Thank you for having me, Matthew. Happy to be
All
back.
right. So you heard the article there. What were your first impressions there of what Mr. Andrews had to say about what he thinks is happening with home prices and what we might be able to expect moving forward?
Yeah, I've actually fallen in line with a lot of his thought process there. I think human greed and failed wisdoms are what really took us down that path in '08. I think just based on past experience, there's checks and balances in place right now. The lenders have a lot of cash. They've had to really haul that in over the last handful of years to avoid another '08, '09 meltdown. Because of that, they're just not in the tough spot. They're not doing ARMs anymore. There's not the liar loans. So there's not people that are waking up 30 days from now and all of a sudden they've got an adjustable rate that is over top of them. They couldn't support from an income standpoint. As you know, it was all self-reported back then. So checks and balances, in my opinion, are in place right now to prevent that from happening. Also, the forbearances, the government involvement. I've seen your videos on the stimulus. I don't think that that's the savior by any stretch of the imagination, but I think that we're just smarter. As far as what the real estate market looks like in general, prices haven't dropped because I think that those sellers still have, and let me just hit pause here. I think it's depending on how you're looking at things. Are you looking at it from a homeowner standpoint? Are you looking at it from a home buyer standpoint? Are you looking at it from an investor standpoint? All three of those are going to be looking at this pandemic and what's going on in the real estate market through different lenses. Sellers still have, in my opinion, that kind of overinflated sense of value. Buyers at this point are thinking it's going to be a buyer's market. There's some data out there from Redfin that's saying sellers are really not adjusting their prices whatsoever, but buyers, when they're being polled, are saying, well, they're expecting some sort of anywhere between a 5 and 10% decrease in the sale price of the homes or the listing price of the homes, and they're just not seeing it. So I think from the buyer standpoint, there's not going to be enough supply right now. I think sellers and buyers are kind of taking that wait and see approach. Sellers are not chomping at the bit to list their property, then have multiple reductions in prices. Buyers right now, particularly traditional buyers, are in that kind of wait and see. They want to see what happens to home values over the next 2, 3, or 4 months. So I think that stalemate is exactly what we're going through right now.
When will that change as far as sellers becoming more desperate as unemployment begins to affect things? Obviously, the stimulus might be cushioning, giving these few extra months of breathing room. But when does the unemployment or underemployment come into play? Obviously, unemployment numbers are astronomical. I mean, arguably as much as 23% if you're counting the underemployed or even people who have given up looking for new employment. I mean, unemployment is calculated based on people who are still actively looking, which means that the numbers are always going to be misleading, right? It also doesn't count people who are self-employed who have suddenly seen massive drops in revenues. And again, sure, there's been some stimulus to help support in that. Not everybody who's needed it has gotten it, which means that even if you have, there's a life expectancy here. There's a expiration date to when all these Band-Aids start failing and you start bleeding through. So I guess my concerns and really where I'm trying to forecast things are going to boil down mostly to unemployment. When you look at the Department of Labor has this incredible graph. Basically what you'll see is from 1970 to present day, unemployment rates adjusting. And there's a real terrifying surge this year that I think gives perspective to what we might be facing. That is the single most concerning number for me, is how do we wiggle our way out of the hardships that people have fallen into at this point. We're talking about an 8.8% forbearance rate right now. Almost 10% of the mortgages that are out there right now are in forbearance. When I called my mortgage company, it was so simple to get them to agree to a 6-month delay of payments, right? And what happens at that 7th month when I can't come up with that lump sum amount? And they're going to go ahead and extend it another 6. They've already told me that. And then what happens at the end of that 12th month when in month 13, I can't come up with $33,000 worth of mortgage payment at one time to get caught up? There are only so many choices at that point, right? The mortgage company either works with me on a modification. They're not going to continue to perpetually protect my credit. I'm going to run into a liquidity crisis at some point if I'm unable to get caught back up, which means that I'm going to have to either hit the market with my property to try and take out what is my perceived equity position at that point, and will continue to reduce my price tag to do that, or I face the repercussions if they're unwilling to work with me further, or the government comes back in and bails us out again, right? So now I do want to preface that by saying, guys, don't use the forbearance option unless it's absolutely necessary. This is something that we've been talking a lot about, that it is a get out of jail free card, but it also could potentially injure your ability to invest moving forward in what may end up becoming one of the best buyers markets or inventories or opportunities that we'll see in our lifetimes. Who knows? So you just don't want to bench yourself by going into a forbearance and not paying if you can. So even though I went through that process, I paid as agreed. I even paid more just to accelerate the elimination of the mortgage like we teach here on the channel. But I just wanted to jump in and tangent that real quickly because it is really important. So what are your thoughts on all of that? I mean, can we not to some extent forecast that 1 year from now, there will inevitably be this unsolvable surge of people who are unable to get caught back up and get current with their mortgages?
Yeah, I definitely agree with that. Obviously, there's not been a huge change in real estate prices at this point. That blood in the streets that we've talked about, I don't see it happening right now. The Fed has already come in and purchased over $1 trillion in mortgage-backed securities right now to stabilize the market. That's huge. Obviously, that didn't happen the last time we kind of went down this path. Buyers are out there right now. 5.5% increase, according to Redfin, right now on buyers actively searching for homes. And that was pre-pandemic compared to today. And that data is maybe 2 weeks old, maybe a week old. But these people that are searching for houses, they're fairly abundant, but they're in that wait and see approach. So something's got to give here. The buyers are out there looking. The sellers are reluctant to sell. It puts them both in this holding pattern. None of us have the crystal ball. I think that we both have methodology and how this is going to kind of play out over time. It's not an if, it's a when. It's either going to go one way or the other. I'm curious to see from an investor standpoint. So I'm not out there actively trying to buy an owner-occ house or trying to sell a house that I'm actively living in right now. From an investor standpoint, if I'm out there buying for cash on the regular, I'm not doing anything right now. I mean, period. Housing prices have not diminished. The foreclosures are not spiking right now. I think just based on the checks and balances that the big banks have in place. But conversely, JP Morgan Chase just came out, I guess maybe 30 days or less ago, and they just made their banking restrictions even more stringent for you to go in there and get a traditional mortgage right now. It's 700 plus credit score and 20% down. I mean, 10% down. Now, 700 credit is a little bit less than average. That's still a reasonable credit score to go out there and secure some credit, but the 20% down, particularly in my business, and I deal in higher dollar homes, 300,000 up to $1 million plus, to get someone that's going to be looking at that house and have 20% down to sitting in the bank or access to that liquidity is going to be a challenge. So I am very curious right now. And 07, 08, 09, when all of that was happening, the market was at the top and then it completely fell out. I was a part of that just like you were. So, I'm very, very curious. I'm perched and primed and ready, whether I'm out there buying for cash or in my business where I'm, selling in franchises of people that want to take advantage of our system. I think that we are just primed right now to take advantage of this. And again, and I've said this in subsequent or previous videos, well, I'm not out there hoping for people to lose homes. I'm never going to sit and cross my fingers, or my team's going to sit and cross their fingers and hope that bad things happen to good people. But just like your audience that's listening right now or watching your videos, if you aren't preparing for those types of things, you're going to get left on the sidelines, because people like myself and people like you, we're looking at this through a microscope right now, and we're trying to analyze it and we're trying to forecast. If you're not doing that, you're going to miss possibly one of the best life-altering, wealth-generating housing markets in the history of the world.
Yeah, well, it'll always boil down to the topics that we teach on this channel. Again, if you're not a subscriber, consider subscribing. We talk about better credit being the pursuit, because it will always provide a leverage point into more wealth. So improving credit, good credit, great credit, excellent credit being much, much better than less than perfect. Having access to more capital being much, much better than having access to fewer dollars. Having access to more income and assets being better than having access to fewer. And ultimately paying debts off and driving a cash flow stacking process to where you have as much money left over at the end of every single month as possible. And the ultimate way of doing that, from my calculations and experience over 20 years of being in business and investing in real estate, has been to solve the short-term net cash flow equation. And what that ultimately means is finding high streams of income that you can develop and scale, which allows you to then direct the cash flow that comes from it into long-term net worth investing, which is where my investments in real estate have come from, my best investments in real estate. And before I did this, before I followed that plan where I was solving the short-term net cash flow equation and then scaling it out and then buying these long-term net worth assets, I was buying long-term net worth assets and wondering why the needle wasn't moving. So one of the reasons that we always enjoy Michael coming here on the channel is because, as the owner of a company called Little Pink Houses of America, he provides one of my favorite short-term net cash flow solutions, whereby ordinary people can create extraordinary incomes. And it's a way of even doing it part-time, generating six figures and being able to replace maybe jobs that you're not quite satisfied with, jobs that are kind of leaving you feeling a sense of volatility or uncertainty that, hey, maybe it won't be here in the near future. Maybe you've already been laid off, but we're helping people who are, in some cases, even accessing debt weapons to get access to their business in a box, and have had amazing success with it. In fact, we have an entire playlist of people who are sharing their stories. They're chomping at the bit to get on the channel, which is unique because it's always pretty scary to come onto a YouTube channel where thousands of eyeballs are going to be looking at you. But these people are excited about their results, and they're getting some terrific results. In fact, I'll play a video here tomorrow or the next day that shows yet another success story. I've got a couple in the queue that I can't wait to share. These folks are just having really great success. In fact, we had a 23-year-old kid here talking about already having earned over $100,000 in revenues in, the first several months of the year, already surpassing the income levels of both of his parents who are in retail real estate. So Michael, whether the economy is good or whether we start to actually experience a real estate downturn, how will that affect your business model, and how can people reach out to get more information?
Yeah, great question. And you and I obviously have known each other for years, and I've talked about this to you about us having an inelastic business model. And I think, years ago, you kind of wanted to slap me around, and, you didn't think that our plan was really foolproof, but we knew that there was going to be a downturn. It happens on average every 10 years. There was going to be a correction. Now, none of us anticipated a pandemic being the kind of impetus for that or the driving force behind it, but we're here right now. Irregardless of how we got here, this is where we're at right now. Our business model is perfect for this exact type of thing, for sellers that are either a little bit leery of going on the open retail market. They don't want to continue to drop prices on their homes in a buyer's market, which is what we're seeing right now. They don't want to pay real estate commissions. Everyone's trying to hold on to their purse strings as tightly as possible. Buyers, that JP Morgan Chase example that we just talked about recently, they can have pretty good credit. They can have some money to put down, maybe not necessarily that 20%. They can make a good income. They can support a mortgage payment every single month. But right now, it's going to be tougher and tougher. It was already hard. It was already a challenge. It was already 80% of the population could not walk into the bank off the street right now and get traditional financing on a home.
Well,
and
is
now,
that a surprise? I mean, look, we're at record level highs when it comes to student loan debts, automobile debts, credit card debts, obviously home mortgage balances, and of course the national debt is absurd at this point. So we're dealing right now with somewhere in the neighborhood of about 15 some odd trillion dollars in household debts alone. How can this not catch up at some point when you couple it with the income deficiencies that people are experiencing now more than ever?
Well, and I think just to kind of dovetail off of that, a lot of people that I'm talking to right now are either underemployed or they feel like they're walking that tightrope. They've been in that W-2 position for X amount of years, and now they're saying, they're waking up one week to the next, wondering if they're going to get furloughed, wondering if they're going to be laid off completely. People are sick and tired at this point of potentially being the victim of a big corporation that just wants to cut their neck just to save that money. And now I'm not the big business, so I'm not looking at their financials. I'm not staring at their P&Ls and seeing what makes sense. But if I'm in that person's position and the people that I talk to, they're scared. They want something new. They want a better life for themselves. They don't want to ever potentially go through this scenario if they haven't already gone through it. A lot of people I've talked to have been laid off already. I talked to 3 or 4 people today that have been in jobs 20 plus years. They were experts in their field, very professional, and have lost their jobs recently, and they're fed up. So what we provide is a solution for them to really take control over their financial life, take control over their professional life, their career, if you will, and provide a better life for their family where they're not looking over their shoulder, whether it's a pandemic, whatever the market correction may be, a boss that maybe they don't get along with. I mean, there's all these variables out there that they really can't control right now. We offer them a solution to capitalize on a market that right now is a perfect storm for what we do. Again, we don't hope for bad things to happen to good people, but if you're smart in business, you're going to prepare yourself to take advantage of times when things like this are going to happen. Every investor out there right now that I'm talking to is looking for their angles, right? We're providing a substantial angle for them, a business in a box where they have the support. They've got a very specific blueprint and a business model for them to follow. They never have to wonder what they're supposed to be doing from one day to the next. And most importantly, they're not worried about whether or not they're going to be losing their job. The downfall of this pandemic, it could be, I've seen some procrastinators say 2022. We don't know when the end is going to be in sight. I'm not going to sit around and wait for that. And I know that you aren't, and I know we've got folks in our circles that are out there right now making moves. If you're not making moves right now, you're going to be on the short end of the stick, whatever that means, whether it's losing your job, not able to capitalize on the income potential and the wealth potential that's going on right now. Because if you're willing to kind of take some leaps of faith, you're willing to do the research, and you're willing to, follow your gut, if you will, to make good money, now is the absolute time. Six months from now, we don't know what it's going to look like. I can guarantee you, if you're laying on your couch, love your videos, Matthew, but if they're laying on your couch watching videos all day, not doing anything with the information that you're sharing with them, they're going to lose.
No question. Well, to recap a couple of our past videos, this is something where people can end up working part-time. 15 to 20 hours a week is not impossible. It's not impossible with that type of a time commitment consistently, where you could generate six figures in income from that. We've shown case studies of it before here on the channel. The more time you put in, the more you're going to get out of it. The less you put in, the less you'll get out of it. For people that are not planning on putting anything in, this is not for you. This is not for everybody. In fact, it's for a relatively small percentage of people because, frankly, a relatively small percentage of people are cut out to be entrepreneurs. But like you were mentioning there, Michael, if you are at that point of being sick and tired of being W-2'd and relying on somebody else for your own household safety and your future, maybe it's a good opportunity to make a transition. If you've been on the fence before, just go through the playlist. I don't want to repeat everything that we've said in the past regarding Little Pink Houses of America. I think it's a fabulous opportunity for the right candidates. If you do want more information, email pink@vipfinancialeducation.com. Again, pink, like the color, @vipfinancialeducation.com. Include both your first name, last name, and contact phone number. Somebody from Michael's team will reach out. But before you do that, please be sure to watch the videos in the description below, because it will give you a lot of the answers to the questions you're probably going to end up wanting to get on the phone call anyway. So go into that conversation having already done your homework. If you're not willing to invest a couple of hours of time for a potentially hundreds of thousands of dollars per year business, then you're not cut out to be in business for yourself. It's a very simple formula.
And just so you know, Matthew, I moved back here to Oklahoma City, which is where I lived prior to moving down to Florida, where our Jacksonville corporate office is. We wanted to have a regional, kind of a South regional or Southwest regional office to support local affiliates here. We did not have a real estate office here in Oklahoma City, not by design, but obviously it's a first come, first serve. Some markets are already full. So I do want to definitely say that there is an urgency when the markets are full. The markets are closed. And depending on the size, the population, and available inventory really dictates that.
Yeah, you have geographical capacities, basically. You can't just let anybody in that wants in. If once the market's closed, if that person is seeking that market, they're out of luck.
Okay. Absolutely. And I've had to turn a couple people down this week that were excited about the opportunity, and unfortunately there was not room for them. The least favorite part of my job responsibilities are having to turn people away that see the opportunity here and we can't follow through with them. That being said, when I'm opening up the office here, I did start doing the real estate here as well about 10 days ago at this point, week and a half, following the exact same blueprint, the exact same business model that we share with every single affiliate that comes into us. In the past 2 weeks alone, or less than 2 weeks, I've put together just over $2 million in premium residential real estate that cost me $0. And I stand to gain $40,000, $50,000, $60,000 on those transactions. So, you know, people say, well, you know, you can sit there in your chair all day long and say, this is how it's going to go. This is how it's going to work for you. I've done that in a very, very part-time capacity as an absolute one-man show, utilizing the corporate support that everyone has access to. So I'm a walking, living testimonial as well to our business model. And I plan on making a bunch of money doing it here as well. So
40 grand in 10 days is essentially what you stand to make since you moved to Oklahoma City.
40 to 60. In that ballpark. And yeah, I've been at it about 10 days now in a part-time capacity. I spend 2-3 hours a day working on it, and I work on the weekends too. You and I are both workaholics. I'm never gonna flush that out of my system. But yeah, those are real numbers. Numbers.
Man. That's impressive. Obviously results vary, guys, but that should give you at least a sense of what's possible here. Again, go through the playlist in the description. There'll be a lot more people that you can just hear their stories from and hear about the support too. I think that's a huge aspect to any business affiliation or franchise, is what type of modeling support is available. And that is one of the areas that you guys have received 5-star praise from everybody I've asked the question to. And I really try and get the genuine, authentic feedback from these guys, where half the time I don't even invite Michael onto the call in order to do the video, so that they'll feel as comfortable shooting as straight with me as possible. And I never prep anybody for the question. So we look forward to seeing you on our next video. Be on the lookout in the next day or two for that upcoming review of Little Pink Houses by one of their current active affiliates and see for yourself exactly what they say. It's better for you to take it from them anyway. So Michael, thanks a lot for sharing your input on this, brother. Appreciate you, man.
Thanks.
Yeah.